Friends, thank you for being here today. What if I told you that everything we thought we knew about the silver market, the manipulation, the suppression, the villains, was just a smokescreen for the greatest accumulation of wealth in modern history? And how would you react if you learned that the very bank we have spent 15 years fearing has quietly switched sides, effectively ensuring that the next major move for silver is not a crash, but a historic vertical launch? We are gathered here to discuss a turning point that will likely be written about in financial history books for decades to come. For the better part of a generation, specifically since the financial crisis of 2008, we have operated under a very specific narrative. It was a story of the people versus the banks. We believed, with good reason, that the bullion banks, led by the colossal giant JP Morgan, were the enemies of the honest investor. We believed they were using their massive size and unlimited paper leverage to crush the price of silver, to demoralize the retail holder, and to protect the fiat dollar. We were right about the tactics, but we were wrong about the motive. We thought they were trapped in a short position they couldn't escape. We thought we were squeezing them. But intelligence surfacing today suggests a reality that is far more shocking and, ironically, far more profitable for us. JP Morgan wasn't trapped. They were waiting. They weren't being squeezed. They were engineering a trap for everyone else. Today, we are going to walk through the mechanics of this 15-year master plan. We are going to look at the hard data that suggests JP Morgan has flipped the switch from being the market's biggest short seller to being the largest owner of physical silver in human history. We will explore why this matters for your retirement, your savings, and the future of the global economy. To understand where we are going, we must first come to terms with the new reality. The suppression era is over. We must accept that the war for fair price discovery, which many of you have fought by holding physical coins and bars through years of stagnant prices, has been won. But it wasn't won by a regulatory agency, and it wasn't won by a Reddit forum. It was won because the general of the opposing army decided it was time to change uniforms. For 15 years, the prevailing wisdom was that JP Morgan held a massive naked short position. For those of us who aren't professional traders, let's clarify what that means. To be short is to bet that the price of an asset will go down. A naked short means you make that bet without actually owning the asset to back it up. It is a risky, dangerous game usually played with paper contracts, not real metal. We believed that if the price of silver rose too high, JP Morgan would go bankrupt trying to cover these bets. This narrative is now dead. Recent deep analysis of custodial vaults, warehouse receipts, and market movements indicates that JP Morgan has completely exited those short positions. They have flipped the book. They are now net long. In plain English, this means they have placed a massive wager that the price of silver is going to skyrocket. This changes the entire physics of the market. Imagine you are in a rowboat trying to paddle upstream against a raging river. That river was JP Morgan's suppression machine. No matter how hard you paddled, the current pushed you back. Now imagine that the river suddenly reverses direction. The massive force that was pushing against you is now pushing you forward. We are no longer fighting the biggest bank in the United States. In a twist of fate that is almost hard to swallow, we are now effectively partners with them. Their profit motive has aligned with our preservation motive. They want $100 silver. They want $200 silver, not because they care about truth or honest money, but because they now own the silver. And when the biggest whale in the ocean decides to swim up, the water rises for everyone. Now, let's turn our attention to the vault and the sheer scale of this accumulation, because in the world of commodities, math does not lie. According to the data, JP Morgan is currently sitting on a physical stockpile of approximately 750 million ounces of silver. Let that number sink in. 750 million ounces. I want to pause here for a moment because this number is staggering. What are your thoughts on a single bank holding nearly 1 billion ounces of a strategic metal? Do you see this as a manipulation tactic or a smart strategic move? I would love to hear your perspective, so please leave a comment below with your thoughts. Many of you remember the year 1980. You remember the Hunt brothers, Herbert and Bunker Hunt, the Texas oil tycoons who tried to corner the silver market? They were vilified, attacked by regulators, and eventually destroyed because they bought too much. At the peak of their power, the Hunt brothers controlled somewhere around 100 to 200 million ounces. Their buying alone sent silver from $6 to $50. JP Morgan currently holds nearly 4 times what the Hunt brothers held. And unlike the Hunt brothers, who used borrowed money, margin, that could be called in, JP Morgan owns this metal outright. They are the bank. Nobody can margin call the landlord. To understand just how dominant this position is, we have to look at it relative to the rest of the world. First, let's compare it to global mining. The entire planet Earth, every mine in Mexico, Peru, China, Russia, and Australia combined, produces roughly 830 million ounces of silver a year. This means JP Morgan has effectively removed nearly an entire year's worth of global production from the market. They have privatized 90% of the annual output of the human race. Second, let's compare it to the exchange. We often look at the COMEX, commodity exchange, price to tell us what silver is worth. But the COMEX is running on fumes. The registered inventory at the COMEX, the metal that is actually available for delivery to fulfill contracts, is hovering around 30 million ounces. JP Morgan has 25 times more silver in their private vaults than the entire public exchange has available for delivery. The conclusion is stark. The COMEX is a sideshow. It is a flea on the back of an elephant. The real market, the true supply of strategic silver, is locked inside JP Morgan's vaults in London and New York. They have not just cornered the market, they have become the market. To understand how they pulled this off, we have to look back at the history of this 15-year con game. How did a single bank manage to acquire nearly 1 billion ounces of a strategic metal without driving the price to the moon during the buying process? To understand the method, we have to go back to the scene of the crime, March 2008. The financial world was melting down. An investment bank called Bear Stearns was collapsing. Bear Stearns was the original villain in this story. They were the ones who had built up a massive, toxic short position in silver. They were betting the farm that silver would stay cheap. When the price started to rise, they were effectively bankrupt. The Federal Reserve, desperate to prevent a total systemic collapse, forced JP Morgan to acquire Bear Stearns for pennies on the dollar. When Jamie Dimon, the CEO of JP Morgan, looked at the books of the company he just bought, he found this massive short position. A normal bank might have closed it out, taken the loss, and moved on. But Jamie Dimon saw an opportunity. He realized that this massive short position was a weapon. It gave him the ability to control the price. If you hold enough paper contracts, you can flood the market with sell orders at 3 a.m., trigger panic selling, and drive the price down. So he didn't close the position. He nurtured it. He used it. For the next 15 years, JP Morgan played a game of bait and switch. Whenever silver rallied, when it hit $30 in 2010, or when it approached $50 in 2011, JP Morgan would use their inherited short position to smash the price down on the paper markets. This demoralized investors. It made mining companies desperate. It made everyone believe silver was a dead asset. This was the bait. While the price was being smashed and while retail investors were selling in frustration, JP Morgan was quietly backing the truck up to the loading dock. They were buying physical silver at the artificially low prices they had created. This was the switch. Think of it like this. It is the equivalent of setting your neighbor's house on fire to drive down the property value, and then buying the land for pennies on the dollar after the smoke clears. It is ruthless. It is unethical. But from a strategic standpoint, it was brilliant. They convinced the world they were bearish, that they hated silver, while secretly becoming the most bullish entity on the planet. They spent 15 years transferring the world silver wealth from the hands of the impatient into their own deep pockets. This leads us to the trigger, a perfect storm that is set to begin on January 1st, 2026. Why is this story coming out now? Why does it matter this week? Because the accumulation phase is over. You don't hoard 750 million ounces to keep it as a paperweight. You hoard it to sell it into a panic. And JP Morgan knows that a panic is scheduled to begin in exactly 4 days. We are facing a geopolitical event that acts as the trigger for this entire setup. Starting January 1st, 2026, the People's Republic of China is implementing a strict export ban on silver. For decades, China has been a major supplier of processed silver to the West. But China has looked at the same math we have. They know their solar industry needs silver. They know their electric vehicle industry needs silver. And they have decided they are no longer willing to share. This creates a pincher movement, a classic military tactic applied to economics. From the east, the Chinese government is locking the gates. Supply from Asia is about to hit zero. From the west, JP Morgan has locked the vault. They have absorbed the available float in Europe and America. Western industry is caught in the middle. The supply shock that begins next week is unlike anything we have seen since the oil embargoes of the 1970s. Global supply is effectively being cut in half overnight. The companies that rely on this metal, the giants of our economy, are walking into a buzzsaw. With the trap set, we must identify the victims, which in this cycle are big tech and the green energy sector. In 2008, the victims were homeowners. In this crisis, the victims are the titans of Silicon Valley. For 20 years, companies like Apple, Tesla, Samsung, and Raytheon have operated on a business philosophy called just-in-time manufacturing. They believed that efficiency was king. They believed that holding inventory was a waste of money. They assumed that whenever they needed raw materials, whether it was copper, lithium, or silver, they could just click a button and buy it at the market price. They built trillion-dollar empires on the arrogant assumption that the periodic table of elements would always be cheap and available. That assumption dies on January 1st. Imagine Elon Musk looking at his production schedule for the new Tesla model. He needs millions of ounces of silver for the electrical contacts, the batteries, and the solar roofs. He looks to China. They are closed. He looks to the mines. They are sold out years in advance. He looks to the COMEX. It is empty. He has only one phone number left to call. He has to call Jamie Dimon at JP Morgan. And this is where the wealth transfer happens. JP Morgan is now the gatekeeper. They have set up a toll booth on the bridge to the future. If you want to build EVs, you pay the toll. If you want to build iPhones, you pay the toll. Do you think JP Morgan will sell their silver to Elon Musk for $30 an ounce? Of course not. They didn't spend 15 years planning this to make a 10% profit. They are going to squeeze the industrial users until they scream. They will demand $100, $200, maybe more. The price will be whatever JP Morgan says it is, because they are the only ones with the goods. The wealth is about to flow from the balance sheets of the tech companies to the balance sheets of the resource holders. Before we discuss the endgame, we need to anatomize the coming industrial panic, because the mechanics of this squeeze will be unlike anything we have seen in the paper markets. To fully grasp the magnitude of what is coming, we must look beyond the boardroom of Tesla and into the messy reality of the global supply chain. What happens when a commodity essential to modern life suddenly goes limit up and supply zero at the same time? We are about to witness a phenomenon known in economics as a Giffen goods scenario, but applied to an industrial raw material. Usually, when the price of something rises, demand falls. But in a panic, specifically a supply-driven panic, the opposite happens. As the price of silver rises, industrial users will not buy less, they will try to buy more. This is the psychological phase of the collapse. Think about the purchasing manager at a mid-sized medical electronics firm. For 10 years, his job has been boring. He orders silver paste, it arrives in 3 days. But next week, his supplier calls him and says, "Force majeure, we can't deliver." Panic sets in. He doesn't care if the spot price is $30 or $80. He cares that if he doesn't get the metal, his factory shuts down and he gets fired. He will immediately try to order 3 times his normal amount to build a stockpile. Every other purchasing manager in the world will do the exact same thing at the exact same moment. This creates a bullwhip effect that ripples up the supply chain, amplifying the shortage tenfold. This is where we will see the great decoupling. You need to be prepared for a period where the paper price you see on TV and the street price of real metal completely diverge. The COMEX might try to maintain the illusion of control. They might set the official spot price at $85, but try to buy a physical bar for $85. You won't find it. The real physical market, the gray market between refiners and industry, will be trading at $120, $130, or $150. JP Morgan knows this. They won't sell their 750 million ounces at the fake paper price. They will sell it at the real physical price, effectively bleeding the industrial sector dry. Furthermore, consider the sectors that cannot say no. We talk about iPhones and Teslas, but silver is also a critical component in the defense industry. It is in the guidance systems of Tomahawk missiles. It is in the circuitry of fighter jets. It is essential for satellites. The Department of Defense does not have a price sensitivity. They have a mission requirement. If Raytheon needs silver to build missiles for the U.S. military, they will pay any price. They have to. And since the U.S. government sold off its strategic silver stockpile decades ago, they are now dependent on the private market. This puts JP Morgan in a position of supreme leverage, not just over the economy, but over national security. They effectively hold the strategic reserve of the United States. Do you think they will let that go cheap? Absolutely not. This ensures that the floor for silver is not just supported by investors like you and me. It is supported by the military-industrial complex and the medical industry. These are buyers who buy out of necessity, not speculation. This creates a permanent high-price environment. The dip is dead because the desperate industrial bid will catch every falling knife before it hits the ground. In addition to the industrial panic, we must face the geological cliff. Why the mines cannot save us this time. Friends, there is one common counter-argument you might hear from the skeptics on CNBC. They will say, sure, prices might spike, but then the miners will just dig up more silver, flood the market, and the price will crash back down. It sounds logical. It is the basic law of supply and demand. But I am here to tell you that when it comes to silver, that law has been repealed by the laws of physics and geology. We are facing a phenomenon known as the geological cliff, and it is the final nail in the coffin for the short sellers. First, we must understand the concept of ore degradation. For the last century, we have been mining the easy silver. We picked the low-hanging fruit. The high-grade veins that our grandfathers mined in Nevada and Mexico are gone. Today, mining companies have to move mountains of earth to extract mere grams of silver. The average yield per ton of rock has plummeted by over 50% in the last decade alone. This means that to get the same amount of silver, we have to burn twice the diesel, use twice the water, and grind twice the rock. In an era of rising energy costs, this makes new production astronomically expensive. The marginal cost to produce an ounce of silver is rising faster than the inflation rate. But the situation gets even more precarious when you look at where silver comes from. This is the byproduct paradox, and it is the single most misunderstood factor in the market. You see, 70% of the world's silver is not mined from silver mines. It is a byproduct of copper, lead, and zinc mining. It is an accident of geology. This means that the supply of silver is not determined by the price of silver. It is determined by the demand for copper and zinc. Think about the implications of this. If we enter a global economic slowdown, which many economists predict, the demand for base metals like copper used in construction could flatten or fall. If copper mines scale back production because housing construction slows down, silver production falls with it. We could see a scenario where the price of silver goes to $100 because of monetary panic, but the supply of silver actually shrinks because the base metal economy is in recession. The supply is inelastic. It does not respond to price signals. You could double the price of silver tomorrow. A copper miner in Chile is not going to change his production plan because silver is just a rounding error on his balance sheet. Furthermore, we have to talk about the lost decade of exploration. For the last 15 years, while the price was suppressed by the paper markets, capital fled the mining sector. Nobody wanted to invest in a mine when silver was stuck at $20. Exploration budgets were slashed to zero. Geologists were fired. Equipment rusted. We ate our seed corn. Now, even if the price hits $100 and capital floods back in, you cannot just flip a switch. It takes roughly 10 years to take a new deposit from discovery to first pour. 10 years of permitting, environmental studies, community negotiations, and construction. This means that for the next decade, the supply cake is baked. We are stuck with the mines we have. There's no cavalry coming over the hill to save the industrial users. There's no flood of new supply to bail out Apple or Tesla. The supply cliff is real, it is steep, and we have already walked off the edge. JP Morgan knows this. Their analysts have looked at the core samples. They have modeled the depletion rates. They know that the 750 million ounces in their vault is not just a pile of metal. It is the only bridge across the supply gap for the next 10 years. They have cornered a market that physically cannot expand. This is the definition of a squeeze that has no exit. The only release valve is price. Much, much higher price. This brings us to the endgame, which is fundamentally about a monetary reset and wealth preservation. There's one final layer to this onion, and it is perhaps the most important one for us as individuals. Why would a bank, an institution that creates money out of thin air, want to own a hard asset like silver? Banks usually hate gold and silver because they are competitors to the US dollar. The fact that JP Morgan has accumulated 750 million ounces tells us something terrifying about their view of the US dollar. They aren't just betting that silver goes up. They are betting that the dollar goes down. They see the $36 trillion national debt. They see the inflation. They see the deficits. They know better than anyone that the only way out for the US government is to print money. Trillions and trillions of dollars. This will devalue the currency in your savings account. JP Morgan has built a lifeboat. They have exchanged their paper fiat currency, which they know is melting like an ice cube in the sun, for the most undervalued hard asset on Earth. The 750 million ounce hoard is their hedge against a monetary collapse. This provides us with something I call the JPM put. In the stock market, the Fed put is the idea that the Federal Reserve will step in to save the market if it crashes. In the silver market, we now have the JPM put. JP Morgan effectively owns the market. They will not allow the price to crash below their cost basis because it would destroy their own capital. They have put a floor under the price of silver that is as solid as the concrete in their vaults. Finally, I want to leave you with some strategic advice on how to navigate the chaos ahead. What does this mean for us? What does it mean for the retiree in Florida, the grandmother in Ohio, the veteran in Texas who has been stacking silver coins for years? It means you are right. It means your patience is about to be rewarded. But it also means you need to be disciplined. First, ignore the volatility. As this transition happens, it will be chaotic. The banks may try one last false flag operation. They might smash the paper price down one last time to try and shake out the weak hands before the real move begins. If you see the price of silver drop on the news next week, do not panic. Look at the premiums. If the paper price is down but the price to buy a physical coin is high, that is the truth. Do not let them trick you into selling your insurance policy right before the house catches fire. Second, hold the line. Understand what you hold. You're not just holding a piece of metal, you're holding a share in the same syndicate as the most powerful financial institution in the world. You're partners with the predator. Do not sell your silver for paper dollars just because the price goes up a little bit. Why trade a rising asset for a dying currency? And third, consider your exit strategy carefully. People always ask, when do I sell? My answer is simple. You don't sell for cash. You only sell when you can convert that silver into another real asset that generates income. Swap it for land, swap it for a business, pay off your mortgage. Use it to secure your family's freedom. but do not sell it to put digits in a bank account that is being eaten by inflation. Before we wrap up, if you're finding this analysis valuable and want to stay ahead of these historic market shifts, please take a moment to like this video and subscribe to the channel. Your support helps us get this critical information to more people who need to hear it. The world is changing. The era of paper assets, of stocks soaring on zero interest rates, of bonds paying nothing, of digital illusions is coming to an end. We are entering the era of the real. In this new era, he who holds the gold, the silver, the oil, and the land makes the rules. The trap has snapped shut. The tech giants are caught in it. The government is caught in it. But for the first time in history, the little guy, the retail investor who saw this coming, is standing on the outside looking in. We are safe. We are prepared. We are seated at the table with the giants. Sit tight, watch the show, and take comfort in knowing that for once, the wind is at our backs. Thank you.